I think investors are still recovering from that collapse in markets from the December FOMC meeting all the way through December 23rd. Many got very defensive, and so this rally since the start of the year has caught people missing most of that move, actually.
Yeah, and we're seeing that evident in things like fund flows and things like sentiment surveys. So it does seem as if there's been a participation in the rally, maybe it's been grudging. What are you looking for as a signal when finally people say, okay, now it's safe to get back in?
Well, I think people need to make a shift because right now the focus is on earnings recession and E is going down. We've written extensively since the start of this year that PE really determines the outcome for markets in any year. And, you know, if you think inflation's tame, Fed's dovish, massive rally in high yield, potential catalysts in the second half as we get better comps and then a trade deal, that's all PE expanding. And I think, you know, a 16 PE on next year gets you to 3,000 on the S&P, and that's not demanding. So,
what if we don't get better comps and better earnings in the end of the year? I mean, the economic data coming in is far from certain as far as whether we bottom. Did you see the New York Fed manufacturing number?
Sure.
I mean, there are mixed signals on the economy, and I think without more clarity, it's hard to figure out where earnings are going.
Yeah, I'd say that if you look at long lead indicators like the yield curve, the 1030 has steepened dramatically. It's the steepest in more than 2 years. That's going to lead the ISM by 30 months. So the ISM should maybe even break 50 this year because of the oil decline last year. But ISMs are going to turn up. When PMIs turn up, people are going to start to say, oh, forget about what the next 2 quarters E looks like. Let's think about next year.